Hello everyone and welcome to the BDO Financial Reporting Update webinar. We have a year-end update, a year-end update for you today. And so just the admin first of all, the webinar is being recorded, so you'll be able to catch the recording later online if necessary. And if you'd like to raise any questions during the webinar, then hopefully everyone's familiar with the Zoom functionality and you've got those question and on the Q&A function icons at the bottom. And if we can, we'll answer your questions during the webinar or perhaps get back to you afterwards if you do include your name there. So what we are going to be talking about today is firstly, a bit of an accounting update, looking at what's new for the upcoming reporting season, 31st December, year ends, what is coming up a little bit further along the line in case you need to think about disclosing upcoming changes in your accounts, as well as a few other recent IFRS developments. After that, we'll also take a look at what the regulator, the FRC, has been saying. Typically towards the end of the year, they will issue a number of publications setting out findings from monitoring work during the year and summarizing some of the expectations and areas of focus for the next reporting season. So we'll be looking at those. And then finally, a roundup of some recent sustainability and climate change news as well, because there were quite a number of developments timed around the COP26 conference last month. So just before we get into the detail, maybe worth keeping in mind what the sort of key themes are at the moment. Now, the FRC has indicated that from the FRC's perspective, two areas they will very much be focusing on in the next year is firstly climate change related risks, and secondly the ongoing effects of the coronavirus pandemic. More generally speaking, both these two areas and other things going on in the economy at the moment are giving many businesses a significant amount of uncertainty that they need to navigate and address as part of the business. And so that means, so that includes things like rising inflation, wage inflation, some supply chain issues many companies have been struggling with, volatile commodity and energy prices. All of these types of uncertainties need careful consideration and reflection in the annual report. So they will tend to feature in areas like reporting about risks, particularly judgments, estimates, assumptions, disclosures, going concern viability assessments, including the use of scenarios and stress tests, cash flow statements, what actually is cash, what does liquidity risk look like for the company. And one really important message running across to keep in mind is to focus on the consistency of reporting between what goes into the narrative reporting in the front end of the annual report and what goes into the financial statements, so that companies are reflecting the risks, the policies, the commitments and targets and plans that they are explaining to the readers in their actual accounting. So with that, my colleague Moses Zafati is going to take us through some of those accounting updates next.
Thanks, Elisa. Before I launch, I just thought it worth mentioning that our model accounts for IFRS are now out and available on our website if you want to use them to perhaps help you in drafting your financial statements in the coming year. The FRS 102 ones, we'll be hoping to publish them within the next month, so keep an eye out for those. But again, they'll be available shortly. So moving into what's new in the current year, looking at IFRS amendments effective from for periods beginning 1 January 21 onwards. I suppose the good news is there's not much changing, and what there is really tweaking at the edges. I'll start from the bottom of the slide, and I think the biggest change that there is that we're now doing UK adopted international accounting standards as opposed to EU adopted international accounting standards. Again, that's basically just a function of Brexit, but it will mean a little tweak in the basis of prep notes and directors' responsibilities notes in accounts for the coming year. I suppose it's worth focusing on if your period began before 1st of January 21, then you're still technically, or in actuality, under the EU regime, and the wording will be slightly different for the basis of prep. Again, carrying on, moving up the slide, the next one is the amendments to IFRS 16. Again, this was something that was brought in last year as a practical expedient for companies that had adopted IFRS 16, where if there was a change to the lease, you didn't have to account for it as a modification to the lease, which would have meant changes to the right of use assets, relooking at incremental borrowing rates or the inherent rate in the lease. So that original expedient only lasted until for modifications to leases that were only that ended on 30th of June 2021. Well, that's been extended, and if you did adopt the practical expedients last year, then you need to adopt them again this year. So you would need to look at any modifications to leases that might come in the scope of the expedient. If you didn't, then there's not much to do. The next, again, carrying on moving up the slide, interest rate benchmark reform. Again, this is another practical expedient to avoid having too many accounting entries when you move from LIBOR, say, to SONIA, and if there's any modifications to your banking arrangements as a result of that, generally there will be no need to have too much accounting in terms of having a P&L hit. You will just be computing a new effective interest rate. There's clearly other effects of these changes, but again, what it will mean is that if you take the expedients, then there's not much accounting to do, but you've got to give some more disclosures in your financial statements. And the last item on this slide, again, the amendment to IFRS for insurance contracts, allowing entities that are waiting to adopt IFRS 17 to defer adoption of IFRS 9 until such time as they adopt IFRS 17, which we'll cover in the subsequent slide. So if we move on, looking at amendments effective from 1 January 22, so today's first day of December, so 2021 is definitely on the way out. So again, this is a bit of horizon scanning, just making sure that you're aware of forthcoming changes, that if you need to make any changes to your systems to collect information, to adopt these changes to the accounting standards, just keep an eye out for these. And in terms of the ones, so what we have is amendments to standards and then the new standard. In terms of amendments, you've got them listed there on the screen. I'd point out the amendments to IAS 16. If you're a mining company, you might need to change your you might need to change your accounting for proceeds where you are selling products, say, excuse me, before the asset's ready for use. In the past, entities would generally take the revenue against the cost of the assets. This amendment says no, you've got to present the revenue in P&L, so that could be a change, and it's generally retrospective, so you'd have to have information for prior periods for this. Similarly, there's an amendment to IAS 37, and if you have an onerous contract, which costs you would include in the provision. The amendment clarifies that it's not necessarily incremental ones, but it doesn't really go much further in helping you decide which ones. So again, that's something to keep an eye out on. The rest of the amendments, we're going to deal with the amendment to IAS1 in a subsequent slide, but then the other one I'd point out is the amendments to IAS12, deferred tax relating to assets and liabilities arising from a single transaction. This was a change to IAS12, basically as a result of, or came about as a result of adoption of IFRS 16, where that. So I've just received a message that sound quality is not great for some of our attendees. So if you could either on the chat point out if this is an issue. We're not aware it is an issue for everybody, but yeah, so apologies for this. Just I think seems to be good for most people. So on that basis, I shall. Oh, okay. Look, I think we'll carry on, and hopefully, at least the recording will be okay if you're experiencing any current issues. So, just carrying on with the point on the amendment to IAS12, this was a change that came about, like I said, from arising from IFRS 16, or a question that arose, and some clarification was required as to whether the initial recognition exemption was available for transactions where you recognize an asset and liability at the same time. I anticipate this is an amendment which we'll cover in a future webinar, so we're not planning on covering it in this webinar, but again, just raising awareness that this could result in changes. And also wanting to point out, I suppose, that tax is different in every jurisdiction, so the analysis might not be the same. You might have two identical leases in different jurisdiction, and the deferred tax analysis might not be the same. So again, just warning about that. And then IFRS 17 insurance contracts, clearly key impact is going to be on the insurance industry, but it's probably worth pointing out that it might affect entities that are not in the insurance business, and it might affect the accounting for product warranties, residual value guarantees, or financial guarantee contracts. So again, worth looking at IFRS 17 in particular if you've availed yourself of either an exemption in IFRS 4, say for example, on financial guarantee contracts. So again, just something to keep an eye on and to start planning. So if we move on to an exposure draft, again, this is hot off the press, was issued only the last couple of weeks, an exposure draft on amendments to IAS1. This is an amendment to a proposed amendment on IAS1, and it's worth probably doing a bit of a history lesson in terms of what that amendment said, and the way the original amendment to IAS1 was written could have resulted in entities having to classify some liabilities as current when there was either no intention and no I suppose no reasonable possibility of it being having to be paid within the next month. And this was because the way it was written, the amendment would have required entities to test for future covenants based on conditions existing at the balance sheet date. Now, covenants are sometimes written, where let's say a debt to equity ratio varies over the reporting period because of the company's working capital cycle. But the way the way the original amendment was drafted could have meant that you had to look at future covenants but test it by reference to current numbers, which ended up giving a result that was slightly counterintuitive. So this amendment addresses that and effectively scrubs that that requirement from the original amendment, but replaces it with having a presentation change to balance sheets, where if you have a debt that is conditional on compliance with covenants, you would disclose that separately from other debt that isn't conditional on compliance with covenants. Again, we'll see where this one goes. The ED is open for comment, but again, it's something just to be aware of. But at least the good news from this exposure draft is that it removes the old exposure draft, which was causing quite a lot of consternation among preparers. So if we now move on to the next slide, and we're looking at here the IFRS Interpretations Committee agenda decisions. Again, just a reminder on agenda decisions. They are the Interpretations Committee's brought questions by preparers, by auditors on the application of standards, and they will tend to give a view on the accounting, and once they've given a view, if that is perhaps contrary to what entities have been doing in the past, then there's an expectation that entities will change their accounting practices. But these decisions don't have an effective date, which effectively means they are effective as soon as possible or immediately. The chair of the committee has gone on record to say that entities are allowed sufficient time to implement these decisions, but clearly they do bring about change, and it's normally change at short notice. So there's a couple we want to focus on. The first one is on configuration or customization costs in a cloud computing arrangement, and effectively this was building on an earlier agenda decision in 2019, where the committee was asked as to the accounting for cloud computing arrangements, and broadly speaking, the consensus there was that cloud computing arrangements would rarely meet the definition of either an intangible asset or a software lease. So effectively, they ought to be expensed as incurred. Then there was a follow-up question, which is the subject of this March 21 decision, to do with configuration and customization costs. These are costs that an entity would necessarily expend upfront before implementing the software as a service solution. And the question was, well, do these costs meet the definition of an intangible asset? In terms of what the committee decided, they said typically you wouldn't meet the criteria for the intangible asset because the entity does not control the underlying software. And in terms of, then the question is, well, do I need to expense those immediately or not? The committee looked to IFRS 15 in making their decision there, which is a bit of an odd one because we're talking about costs, not necessarily revenue. But what the committee said there was, if these costs, if you look at it from the revenue side, would be part of a single performance obligation, then you would expense them over the period of the contract. If they're not a distinct performance obligation, you would expense them over the period of the contract. So effectively, you'd have a prepayment rather than an intangible asset. If, however, they do meet the definition of a separate performance obligation, then you've received the service, so you would expense them immediately. So again, this is something that for December 21 preparers, we would expect plans and analysis to be quite advanced to be able to incorporate this into December 21 accounts. But clearly, if we do appreciate that it might not be that straightforward to collect information on these arrangements. So you might be able to defer this until a later date. So if we move on to the next slide, which is the agenda decision on electronic payments, and this was again a question brought to the committee as to when an entity should recognize a receipt from received via electronic transfer after its reporting date. The question is, well, are you able to recognize the receipt on origination, which is typically 3 days before the cash lands in the bank, or are you only able to recognize the cash once it lands in your bank? And the committee's answer was, well, in terms of the analysis they went through the assuming this was a receipt from a debtor, when do you meet the derecognition requirements for the debtor? And typically that would only be at the point that the cash is received. So the view that's been put out in this tentative agenda decision is that BACS receipts should only be recognized at the date they hit the bank account. Worth pointing out, this is still a tentative decision. It has not been finalized yet by the committee and the board. So it's something that has the potential to change practice for some entities. We've definitely seen, BACS receipts as reconciling item on bank reconciliations. So it is something that's worth keeping an eye on. If an entity did choose to change its accounting practice, that could be as a change in accounting policy, a voluntary change in accounting policy at the moment. Now, in terms of where this is going to go, the agenda decision is open for comment, and the comment letters that we've seen so far are generally supportive of the analysis that the committee did in terms of, the point of derecognition of the receivable, but there's some concern that this could be quite costly to implement for entities, because different electronic transfer systems might operate differently. So, and you might need to consider, well, at what point is the electronic transfer irrevocable from the originator's side, such that you would be guaranteed to receive the cash. There's also some concern that this analysis could spill over into other areas. Like I said, the question was about a BACS receipt, but what about a BACS payment? Credit card receivables as well. So there's the flavor of some of the comment letters is for the agenda decision not to be finalized and perhaps covered in the post-implementation review of IFRS 9. But again, that's something to keep an eye out on. It could be a big change for quite a few entities. Moving on then to UK GAAP amendments. Again, nothing much to highlight here. The key one here is on COVID-19 related rent concessions. We spoke about the IFRS exemption, practical expedient. Well, there's a similar one under UK GAAP, but it's not an optional expedient. It's compulsory. So again, if you have received any rent concessions, you would need to adopt this for your December 21 year ends. And like I said, there's a few others that are mainly just for consistency and keeping up with the with IFRS changes. We'll now move on to the regulatory piece of this session. And as is normal for the Financial Reporting Council, they tend to produce quite a lot of publications in the second half of the year, definitely in the last quarter. And we've got them listed out here. In terms of the ones we're going to talk about are the annual review of corporate reporting, key matters for 21-22 accounts, the annual review of corporate governance, use of alternative performance measures, and ISO 7 and structured digital reporting. The other two thematic reviews and the two lab reports we've covered in an earlier webinar. So if we move on to the FRC's annual review, the first few bullet points on the left-hand side are what the FRC, or in the FRC's view, worked well. So the quality of reporting did not decline. I don't know how to take that, but I'll take that as a positive. And they also observed improvements in reporting on strategic reports and the use of APMs. And actually, the use of APMs one was more people listened to us and didn't do the wrong thing when it came to APM. So again, those are the positive ones. In terms of areas for improvement, you've got climate change and compliant reporting and compliance with SECR rules. That's the streamlined energy and carbon reporting rules, where again, particularly the SECR, last year was the first year, there were bound to be some teething problems. So they put up some guidance as to how that could be improved. They also pointed out some concerns over errors in cash flow statements. Again, that's something where, as auditors, we tend to see, the cash flow statements are normally prepared at the last minute. They're the last thing that goes into the financial statements, and that means that the review time by preparers and auditors perhaps is not as much as would be desirable. So again, it's just a nudge from the FRC to get those drafted early and reviewed early as well. On the right hand side, you've got what I call the league table of the frequently raised topics, and you can see revenue and cash flow statements moving up, and perhaps financial instruments, the Strategic Reporting Companies Act provisions moving down again. They've become more established. That's probably the reason for that movement. Clearly, also if you do a thematic, you're probably bound to find more points on them. So then moving on to what they say their key disclosure expectations are. Judgments and estimates, those first two boxes on the left hand side, this is a frequent area for the FRC to comment on, and clearly it's about making the user know where a judgment has been made and what the judgment is. That's different, I think, from estimates. Again, there's quite often a bit of confusion as to, is something a judgment or an estimate? Well, a judgment is about, well, I had to decide whether this was a business combination or not a business combination. An estimate is about the measurement, perhaps, of an item in the financial statements. But again, those are key areas where, in the FRC's view, there's perhaps not sufficient disclosure of judgments when they've been taken, and the estimates when they have been taken. Well, what was the key range? What's the sensitivity? What could change, or what could affect this number? They also go on about consistency of financial statements with the rest of the annual report, which I think Elisa mentioned earlier, and something is not about just consistency, it's about apparent inconsistency. So, if something looks like it could be contradictory, then perhaps clarify it rather than leaving the user with questions. I'm not planning on dwelling on the others. You can see them there on the screen, and they're sort of pretty self-explanatory. The FRC also do an annual review of corporate governance and compliant reporting, particularly under the UK Corporate Governance Code. And I think, again, without dwelling too much on what's on this slide, to me a key message is linking. The Corporate Governance Code requires you to talk about a few different things, and in the FRC's view, these are all linked. They're not just standalone behaviors or expectations that there ought to be. And as an example, succession planning, the code wants you to talk about succession planning, but you've also got to talk about the link, because clearly your board might be populated at the moment the way it is. Well, if because of diversity reasons you've got to do something on it, then that must be linked to the succession planning. When somebody is going to retire, how are you going to go about replacing them? What are you going to be doing to address the lack of diversity that currently exists? And I think the key message on this is, it's about avoiding a tick box mentality, and also I think not using this necessarily as a marketing tool, because lots of corporate governance reports do seem to be a bit of a marketing tool. It's about shying away from that and just keep it factual, but keep it relevant to what the the company's strategies and its business model, and how all these things fit into it. Moving on then to the thematic review on alternative performance measures, and again, the messages here are more or less the same ones we've had in the past. About ensuring you don't give up undue prominence or authority to an APM over a statutory number. Reconcile it. Make it easy for a user to see that reconciliation and to understand that reconciliation. So how do you understand that reconciliation? By explaining why you've got an APM, why you're making adjustments to it, and if you've had to apply judgment when computing the number, then disclose that. So again, it's all about telling the user the story, putting it together in a way that's easy to follow, easy to understand, and the FRC also say, well, talk also a bit about the cash flow impact. That's normally something that's lacking or ignored in reporting of APMs. And again, also managing the user's expectations. If you've got a multi-year restructuring program, then talk about it, because otherwise, if you're calling something exceptional or one-off, you wouldn't expect to see it in subsequent years. So then the other FRC thematic which came out recently was on IF37. Again, IF37 is not a new standard, it's quite an old standard, but why is there focus on it? Well, it's because of what Elisa was talking about earlier, the uncertainty. If there's more uncertainty, then there's probably more uncertainty on measurement, or if it's uncertainty dependent on events. Again, how certain are we of those events, that those events will happen? But basically, these blue boxes here on the right hand side is just stuff that ought to be in a set of accounts where you've got provisions or contingent liabilities. And again, these are just reminders of what to do. And clearly, the FRC is saying, well, make it entity specific, don't make it generic. Give me quantification, give me a range of exposure if you can tell me about it. Talk about the timing. When do you expect these things? Just because they're in provisions and then non-current, I still want to know a bit more than just there's this contingency. And then the last box on the right, management commentary. Again, contingent liabilities and provisions are not something that's discussed very often in the front end of the accounts, and the FRC are right to challenge. Well, if you've got big numbers there and big uncertainties, then you ought to be talking a bit more about them in the front end. And the last communique from the FRC that I'm going to be talking about is a lab report on structured digital reporting. Again, at the moment, this is mainly affecting certain companies, i.e. issuers admitted to trading on a regulated market, but they are now required to produce annual financial report in an electronic format that's tagged. This will then allow all reports that are produced in the same way to be compared, and this lab report, again, without going into too much detail on it, is giving you helpful tips on how to do that tagging and that and how to work through that process. So if you're caught by the digital reporting, then it's probably worth having a look at this lab report. So that's it for me. I now hand over to Elisa, who's going to talk about sustainability and climate change reporting.
Thanks very much, Moses. Hopefully everyone can hear me again now. Okay. So we've already mentioned that the FRC is intending on focusing on climate-related matters, climate risks and opportunities and policies that companies are reporting. And that is in the context of the various current reporting requirements that are in place. So UK companies already have a number of narrative reporting requirements that do address environmental matters. And there's also at the moment a big push to make sure that companies are actually considering whether there are any accounting effects to either account for or to disclose in their financial statements, or perhaps to explain why there are no accounting adjustments or what kind of assumptions have been made related to climate considerations and risks in putting together those accounts. So just as important to remember that part, that this aspect of climate change is relevant to every single company, whichever GAAP you're applying, IFRS or UK GAAP. In fact, there has been some recent guidance issued by the FRC for UK GAAP FRS 102 preparers on preparing their financial statements. So we're going to look at some of the recent reminders and guidance on those current requirements. But the other thing is that there has been a huge demand for additional sustainability related disclosure from investors and others globally. And for that reason, the underlying sustainability disclosure frameworks and moving towards the actual standards has been an area that's been moving very fast, particularly in the last perhaps 18 months or so. And this year we've just had the COP26 conference here in the UK in November, and there were a number of quite significant developments around enhancing disclosures around sustainability, particularly climate change going forward, that were timed around the COP26 conference. So we've got a bit of a news roundup on what those changes are. So broadly, 3 different things kind of going on there. One, to expand TCFD reporting in the UK, which is our sort of initial step for asking initially the largest companies to go into greater detail about climate related risks and what effect they have on the company. So to begin with, it's premium listed commercial companies who now for 2021 under the FCA's listing rules are required to produce a comply or explain statement. But the scope of that requirement is going to be expanded from 2022 by the FCA to certain standard listed companies. And now we also have some legislation in place for mandatory reporting under the TCFD, which we're going to go on and look at. Then in addition to that, we also have some global developments on hopefully some global sustainability disclosure standards coming through pretty soon in the next few years, and also a broader UK sustainability disclosure framework, which will sort of cover all of this and a broader variety of issues such as transition plans and also a green taxonomy. So hopefully that kind of makes sense put together in that way. So what is it that's happened recently? First thing, some draft legislation published just at the end of October that is subject to parliamentary scrutiny and approval. But this is to amend the requirements in the Companies Act relating to what currently is the non-financial information statement. So at the moment, it's only large pies with more than 500 employees who are required to produce a non-financial information statement, but that's going to become a non-financial and sustainability information statement and will include some mandatory disclosures based on the TCFD framework. So that means some specific disclosures required about governance, about climate-related risks and the effect they have on the business, how that's integrated into the business's risk management, and the metrics and targets, KPIs that the company is using to monitor progress in that area. And the proposed effective date for these regulations is for periods from 6th of April 2022 onwards. And this will include those companies currently producing those non-financial information statements, and additionally AIM-listed companies with more than 500 employees, and also some of the largest private companies who have more than 500 employees and more than 500 million turnover. There'll also be some separate regulations to follow for LLPs for a similar size. Okay, so that's a UK regulatory requirement for TCFD aligned disclosure coming up quite soon. Then also from the government here in the UK was a policy paper, which was a roadmap they called greening finance, and this followed from some of the other green finance strategy and net zero strategy policy papers that the government has put out to explain what sustainability disclosures will look like in the UK in the coming years. And this is basically building on that first step of TCFD implementation for the largest companies, and it will incorporate a wider variety of disclosures, but all structured around the core concepts of TCFD. So the risks, the governance, the effects on strategy, and metrics and targets. And so the FCA is looking at implementing some separate disclosures for asset managers, asset owners, and investment products. And then for companies reporting in their annual reports, what this paper indicated was that the UK government does intend to put in place a mechanism for adopting and endorsing the international sustainability standards, so those issued by the ISSB, which we will talk about in just a second. Two other things worth being aware of from these policy announcements around COP26 is that the UK announced plans to mandate some net zero transition plans for the very largest companies. So we're expecting some consultations coming through probably next year on that. So that means actually setting out how businesses intend to reach net zero commitments in line with the sort of Paris-aligned scenarios. And the other thing there is a UK green taxonomy. You may have heard of an EU taxonomy. It's basically a way of putting some structure into which business activities can be considered green. And this is to address the risk of greenwashing so that investors reading listed company annual reports can have a reasonable understanding of whether this business is really green or not. So there'll be some structure to that with a requirement to disclose whether the business is taxonomy aligned or not. But so this is policy announcements at the moment, so will require consultations and some legislation in the next few years. On the global front, during COP26, we had the announcement of the formation of what's called the International Sustainability Standards Board. So this is a new standard setter that has been announced now by the IFRS Foundation. So that's the body that sits above the IASB, who set the IFRS accounting standards. And so this board will sit alongside the IASB and come up with some sustainability disclosure standards, and they intend to work to rather quickly to address the initial concern, which is a climate standard. And we are at the time of this announcement, they actually released 2 prototype standards. So those are working drafts of something that's been put together based on some of the current voluntary disclosure frameworks that exist. This includes the TCFD. So in case anyone's thinking that, oh goodness, we've got to implement TCFD and now there's some other standards, actually it's building on from that TCFD. So there shouldn't be any kind of effort hopefully wasted or anything inconsistent, but this will be there will be other things included as well, including some sector specific metrics similar to what's currently included in the SASB sector specific metrics. So we do expect to see an exposure draft of the first climate standard from this new board next year, as well as the target is actually to finalize the standard in the next year for a possible effective date of 2023. So that does demonstrate quite an ambitious timeline to the work of the ISSB. They are able to draw from the expertise and skills and people by consolidating some of the existing voluntary sustainability frameworks into the ISSB, and that includes 2 organizations called the CDSB and the Value Reporting Foundation, which is the one currently setting those SASB metrics. Okay, we do have a video publication that explains some of this in a little bit more detail. So that's what we're looking for in the coming years. Back to what we have now and the current requirements. Again, there's the FRC repeated in their year-end communications their expectations for climate reporting, which were originally set out in a climate thematic this time last year. And what they are really looking for is for companies to increase the level of specific information in annual reports about exactly, rather than just maybe ambitions or statements of intent, going into greater detail about what are the environmental policies that the business intends to pursue. If you have set things like net zero targets or commitments, to explain what does that mean? What are the emissions that the business is planning to include and address, and what does that mean for the strategy and the actual business plans and the underlying business? Is it something that's achievable? How are you going to achieve it? Are there any interim targets that have been set, and what does the progress look like against those targets? So this is an area where practice at the moment is very much still developing and emerging, and there is not that much high quality reporting yet in that area. When disclosing the impact of the business on the environment, so this could be in non-financial information statements or in the streamlined energy and carbon reporting disclosures about emissions, then it's important to be clear about which emissions are being included and how does that link to the business. So for example, are you including or not including your supply chains and the products and services that the business is offering, for people to really understand what do these numbers mean and how does that relate to the overall environmental the policies and strategies and risks. Okay, on to the financial statements. This is where there is the key message is to make sure that all of these risks related to climate, the opportunities, the policies being pursued, any commitments need to be consistently reflected in the financial statements. And that's currently not necessarily the case. I think there's been quite a lot of research done into this recently. All kinds of organizations, some investor groups, lobbying groups, I think people like Greenpeace, I think just yesterday issued another call for action on the fact that there are various companies that disclose climate related risks. They disclose even climate net zero commitments and targets, but there might not be any mention of climate in the financial statements themselves. So what is that looking at? That involves explaining in your accounts how those risks, commitments, transition plans, any intentions for investing in renewable alternatives, technology, how is that reflected in the financial statements? So maybe disclosing in your judgments and estimates, areas like impairment reviews, in asset lives, financial instruments, fair values, how are these policies and targets and commitments being reflected? Now, sometimes companies come back and say, well, it hasn't had any material effect on my current year numbers, so that's why there's nothing to say and there's nothing to disclose in the accounts. But here, just a reminder that the way materiality is defined at the moment is that information is material if it's relevant to the primary users of the accounts and affects their decision making. So sometimes if we know that the investors, for example, are very much interested and expect the business to be affected by climate related matters, then there is a need to consider if information about the climate and how it's reflected in the financial statements might be material. So that could mean explaining why there isn't an impairment, for example. To articulate what are the assumptions that have been used and why they are or are not affected by the climate-related risks, opportunities, commitments, perhaps to say whether the assumptions are aligned with net zero and Paris-aligned assumptions or not. Okay. Now, just for those companies who are preparing for TCFD reporting, just to highlight that there is a piece of guidance from the FRC, an FRC lab report, which comments on the current reporting that they observe with some illustrative examples, and also reminding companies about areas to maybe improve on, generally around, similar to those overall comments, is building in more specific information into TCFD reporting. Few companies can comply with TCFD in its full form necessarily at the first go. So often it's a sort of evolutionary process that takes a little bit of time, and many companies are disclosing sort of areas that they intend to expand and improve on and go into greater detail with things like scenario analysis. Now, scenario analysis is one of the very challenging aspects of TCFD reporting, and looking at what the business would look like, what the financial effects would be under different climate change scenarios. So there's also some additional guidance on that in the form of a research report that the FRC commissioned and published. Now, additionally, from the TCFD itself, there has been some additional guidance, including a new version of what's called the TCFD Annex. So this is a supplementary document that accompanies the main disclosure recommendations, and it's actually referenced in the FCA's listing rules. So if you are within the scope of the FCA's listing rules, you are expected to refer to this Annex guidance, and there have been a few changes to that, particularly in the areas of metrics and targets and focus on companies disclosing financial effects. So a bit more on the quantitative information rather than just the sort of narrative around the governance and risks. So do take in addition to that, sorry, the last item there is a third specific guidance document looking at metrics, targets, and transition plans, which that transition plan thing will be very relevant for any of those large UK companies that fall under the UK government's mandatory transition plans as well. So additional guidance there to look at, and that brings us to the end of the sustainability update as well as our webinar content today. Now, have we got any questions on I'm just checking for, do we have any questions that we need to answer? I don't think we have any open questions at the moment. So with that, we'll close the webinar, and we hope you found it useful, and please join us again next year.